This journey begins with a profound story of transformation, a story of building a business with hundreds of millions, even billions, in turnover, operating across multiple cities, a conventional business that many might overlook, the pet industry. It is the story of a successful founder who constructed his empire from the ground up by recognizing an opportunity and committing to a vision. We are not just talking about scaling a company. We are discussing the necessary shift in mindset and the concrete steps required to execute a business plan that moves beyond daily transactions into true wealth creation. Before we dive into the 5 levels of entrepreneurship that define this growth, there is a core lesson to absorb from the entrepreneur's experience. My biggest mistake was that I did not believe in things like public markets or digital assets. I never believed in them. I thought my own traditional business was the ultimate investment. If I had maintained a more open mindset, perhaps I would be wealthier than I am today. It is a powerful acknowledgement of how a closed mind can cap your ultimate potential. Welcome to the Wealth Up Hub, where visionary mindsets turn into real wealth actions. Your future self thanks you. When we consider the path to building a massive enterprise, we have to look at the structure, the evolution, and the intentional steps taken to grow. This successful owner, like many accomplished figures, broke down the journey into 5 distinct levels of an entrepreneur, starting from the most basic. Level 1, the self-employed. This is where nearly every entrepreneur begins. You work for yourself. You are the only employee. You have no staff to manage, which brings a certain level of control, but also creates a hard cap on your revenue potential. When you are the one doing all the packing, running the register, handling the logistics, and managing the accounting, reaching a target of millions in monthly turnover becomes incredibly difficult, almost impossible. There is a timeless proverb that captures this limitation. If you want to run fast, run alone. But if you want to run far, you must run with a team. In the early stages, it is natural to feel a deep reluctance to delegate. Many new business owners fear relying on employees, worried they might steal, mismanage cash, or ultimately harm the business. This "I don't trust anyone" mindset is one of the most significant barriers to growth. If you stay in this silo, your business simply cannot scale to the multi-million-dollar mark. You cannot break through that ceiling. You will always be limited by your own time and capacity. For a conventional business, like the founder's pet food import and retail operation, doing all the physical labor and daily management alone makes exponential growth unachievable. Level 2, the manager. The transition to this level is a realization that you must scale up. The manager level begins when you hire your first 1 or 2 employees. But to truly graduate from this phase, you need to establish a complete structural foundation. 7 core divisions that allow the business to run and generate revenue, even when you, the owner, are not physically present. Our guest, for example, can travel or manage other projects, and his company continues to operate seamlessly because these divisions are in place. These 7 essential divisions are: 1, sales and marketing, the engine that sells your product and attracts customers. 2, operations, the function that handles everything related to execution, inventory, logistics, shipping, warehousing, and all the physical movement of goods. 3, finance, the division that manages the cash flow, tracking money coming in and going out, and handling the overall cash cycle. 4, accounting. This is a vital but often overlooked division that records profits, losses, and provides the reports the owner needs to make strategic decisions. Knowing your exact financial standing, for example, that your operation costs are too high or your profits are low, is critical for efficiency and for making decisions on where to allocate resources, such as increasing the marketing budget. 5, administration, the division that handles all corporate and HR matters, including legal compliance, industrial relations, and employee management. 6, production or purchasing. If you manufacture, this is your production arm. In the founder's case, as an importer, this is the purchasing division, responsible for procuring and bringing in goods. 7, business development. Crucially, this division exists to help the company evolve and adapt to the ever-changing market. The modern era is so dynamic that a business must have an eye on future trends to ensure it is not left behind. A common question at this stage is whether the owner can take on multiple divisional roles, especially with limited capital. The answer is yes. Initially, the owner must be able to perform or at least deeply understand every single one of these roles. Otherwise, you risk being misled. However, the owner's ultimate role, especially as the business grows, is not to execute technical tasks. It is to focus on business development and growth. If you are too preoccupied with the daily technical details, you lose the time and mental space required to think about how to grow the company. The movement from level 1 to level 2 must be gradual and strategic. You hire only when the load becomes so heavy that your cash flow and potential growth are negatively impacted. For instance, hiring an accountant becomes necessary when the tax reporting and transaction volume become too complex to handle alone. This transition is not fast. For the founder, moving from self-employed to the manager took roughly 5 years, often involving trial and error in hiring the right people. Level 3, the director. Once all 7 divisions are fully formed and functioning, you enter the director level. Here, the divisions now have managers, and your job is to oversee those managers. Your interaction is not with the junior staff. It is a direct line to the division heads. You become the decision maker, looking at reports, data, and giving high-level direction, but no longer executing the core operational tasks. Level 4. The investor. The transition from director to investor is arguably the hardest one. The owner, who has a deep, almost parental attachment to the business, it is their baby, must now find someone who can duplicate their DNA and drive. The core requirement to pass this level is that the owner can stop working entirely, only reviewing financial reports, and the business continues to run and grow aggressively. This requires finding a capable partner or CEO who is as passionate and effective as the founder. The entrepreneur admits he is currently in a transition between level 3 and 4. In some smaller ventures, like his veterinary clinic, he is purely an investor. He put in the capital, and a partner runs the operation. He only reviews the monthly profit reports. However, in his main multi-billion-dollar conventional business, he has yet to find the perfect replacement and is still actively involved. This brings up the concept of autopilot. Many business coaches preach the possibility of a 100% passive autopilot business. The founder believes this is largely a myth. A business where the founder is actively involved will always outperform one where they are completely hands-off, especially one built from scratch by the owner. Even the directors of the world's largest companies still consult with the core owners for critical decisions. True 100% autopilot, in his experience, does not exist. Level 5. The real entrepreneur. This is the pinnacle of the entrepreneurial journey. The real entrepreneur does not focus on running a single business for the long term. They focus on the strategic buying and selling of companies. They identify a business, a restaurant, a retail chain, a factory, that has good bones and strong potential, but is being poorly managed. They acquire it, inject their high-level management expertise, fix the internal systems, aggressively optimize marketing, grow the revenue, and then sell it for a significant profit. This level is about trading companies, not commodities or services. The big pivot: why a conventional business owner is analyzing digital assets. It was after seeing this 5-level framework that the entrepreneur's mindset began to shift significantly. He started to look at the new financial asset classes, specifically digital assets, and decided he wanted to explore this world full-time. He is even considering selling his thriving 10-year-old conventional import business. Why exit a successful business that has made him a leading taxpayer in his region? Because he sees an opportunity for potentially faster, greater, and simpler profit. But it is vital to acknowledge the high risks associated with this volatility. The conventional business model, while successful, carries immense pain points. Illiquidity. For 10 years, every profit earned had to be reinvested, compounded into more inventory and more property. This means that hundreds of millions in profit are locked in physical stock and real estate, which is not easily convertible to cash. Selling property can take months, especially in a slow market. Operational pain. Conventional business is a constant headache of logistics, staff theft, truck accidents, and managing accounts receivable, all requiring constant physical oversight. In stark contrast, he sees the potential of digital assets as providing unparalleled strategic advantages, despite the acknowledged risks. 24/7. Liquidity. The primary digital asset market operates 24 hours a day, 7 days a week. An asset like Bitcoin can be converted to fiat currency in minutes. Compared to traditional markets with open and closed times, this is perpetual liquidity, exponential growth potential, and volatility risk. While conventional businesses of significant size might only see a 10% annual profit margin, the volatility of digital assets offers the potential for significantly larger returns in a shorter time frame. However, this potential is directly tied to the risk of extreme price drops and total loss of capital, which is a constant factor in this highly speculative market. Collateralization and debt efficiency. This is one of the clearest structural advantages being explored by large capital players. In decentralized finance, high-value assets like Bitcoin can be used as collateral for low-interest loans. This means a large capital holder can borrow the cash they need for living expenses or new ventures by pledging their Bitcoin, but they never have to sell the asset itself. Because the interest rate on the loan is minuscule compared to the potential long-term price appreciation of the underlying asset, one can generate cash flow without triggering capital gains tax or losing out on the asset's growth. It must be noted that these loans carry liquidation risks if the collateral value falls too low due to market volatility. The investment thesis behind digital assets. The entrepreneur's conviction in Bitcoin's long-term value is rooted in pure fundamental supply and demand, viewing it as a unique asset class rather than just a currency. 1. Finite supply. Only $21 million Bitcoin can ever be created, a fixed supply hard-coded into the protocol. It is an asset with hard, unchangeable scarcity, unlike traditional currencies which can be printed endlessly. 2. The halving mechanism. Approximately every 4 years, the reward paid to miners for securing the network is automatically cut in half. This artificially reduces the rate at which new Bitcoin enters circulation. In simple economic terms, the cost of producing new Bitcoin goes up exponentially over time, which exerts massive upward pressure on the price. 3. Massive adoption. Global institutional demand is rising rapidly, with large financial institutions and even nation-states beginning to integrate Bitcoin into their strategic reserves and investment products. With a restricted supply and ever-increasing demand, the price is structurally positioned for long-term growth. However, this outlook is highly speculative, and past performance is no guarantee of future results. Digital asset investment is not suitable for capital you cannot afford to lose. For a senior entrepreneur, this is the final great opportunity to adapt and capitalize on a paradigm shift. The younger generation has the advantage of time, but the older generation has the advantage of capital, and those who choose to be adaptive will ultimately win the wealth race. The story of the 5 levels of entrepreneurship and the subsequent strategic analysis of the digital finance world highlights a powerful reflection on the biggest mistake an entrepreneur can make. If you are currently on the path of building or scaling a conventional business, know that the path is honorable and necessary. If everyone was solely an investor, the economy would grind to a halt. But always remember this crucial advice. My biggest mistake was wearing horse blinders. I thought my business was the greatest, the only way to build wealth, and I pushed all my capital into it. I did not believe in diversifying into other asset classes. Had my mindset been more open, I would have had a much higher net worth today. Your key takeaway should be to maintain an open, adaptive mindset and never let your deep personal attachment to one venture prevent you from strategically exploring other opportunities. This brings us to a summary of today's insights. In review, the lessons from building an empire and knowing when to pivot come down to a few core steps. 5 levels of growth. Understand that business success is a structured evolution from the self-employed to the manager, director, investor, and finally, the real entrepreneur who trades companies. Structural necessity. You must establish a 7-division structure: sales, operations, finance, accounting, admin, purchasing, production, and business development, to break the revenue ceiling of a self-employed role. The owner's real job, your primary function as an owner, is no longer technical execution, but high-level delegation and business development. Liquidity versus locked capital. Conventional business success often locks profits into illiquid assets like inventory and property. Digital assets offer superior 24/7 liquidity, but at a cost of extreme volatility and risk. The collateralization advantage. For those with high capital, digital assets can be used as collateral to secure low-interest loans for cash flow, allowing the investor to hold the appreciating asset long-term. The mindset mistake. The greatest obstacle to wealth is a closed, horse-blinder mindset that prevents you from diversifying capital into potentially higher growth, though riskier, financial opportunities. Remember, fortune may come from things beyond our control, but what is in our control is the action we take today. So if you found this video helpful, don't forget to like, subscribe, and share, because like and subscribe are in your hands. Thanks for listening. I'll see you in the next one. The Wealth Up Hub, level up your wealth.